Introduction: The illusion of a ceiling. Is the American housing nightmare nearing its end, or is it just beginning? For years, the consensus has been identical. Prices have hit a wall, and buyers are pushed to the brink. Logic dictates that values cannot climb higher. Yet, every emerging data point contradicts this optimism. The median age of a first-time homebuyer is now pushing 40, the highest on record in modern history. Simultaneously, the typical mortgage payment on a median-priced home now devours nearly 40% of the median household income. In specific metros, that burden is skyrocketing toward 90%, figures that do not merely strain family budgets, they shatter them. Despite these signals, a quiet, dangerous assumption persists that we must be near the limit. After all, how much deeper can the affordability crisis realistically go? The sobering reality is that the U.S. housing market is nowhere near its structural ceiling. When we analyze the forces defining today's prices, interest rate handcuffs, regional polarization, job centralization, construction deficits, and insurance volatility, it suggests America is merely in the early stages of a much more profound crisis. Minor dips in median prices over recent years have fueled a dangerous illusion. However, when transaction volumes plummet, the data ceases to reflect the full picture. Prices are not falling because buyers have more purchasing power. They are softening only because the market has ground to a halt. In this breakdown, we will dissect the U.S. housing market across 4 distinct levels. We begin with the surface-level symptoms visible to everyone and descend toward the structural forces almost no one discusses. Stay focused, because by the conclusion of this analysis, you will understand why the United States may only be in level 1 of a far greater housing transformation. Level 1. The surface reality. The broken metric of affordability. On the surface, the American housing sector appears to be in full-blown crisis mode. When the typical home costs roughly 5 times the median household income, the system appears stretched to its breaking point. Historically, a healthy market operates closer to 3 times income. Anything exceeding 4 is classified as severely unaffordable. By this metric, America crossed the red line long ago. However, a deeper analysis reveals this isn't a peak, it is a baseline. Mortgage payments consuming 40% of a household's income is only part of the equation. This figure conveniently ignores the non-negotiable costs of ownership, surging insurance premiums, property taxes, maintenance, and utilities. In select metropolitan areas, total carrying costs are devouring 90% of take-home pay. This effectively means the average family is mathematically eliminated from buying the average home. The volume illusion and rate lock-in. This sounds unsustainable because it is. Yet, strangely, national home prices have refused to crash. While the median sales price retreated slightly from its 2022 apex, leading some to prematurely celebrate a return to affordability, this interpretation ignores the collapse in volume. Sales transactions have plummeted by more than 25% compared to pre-pandemic levels. The median price no longer represents the entire market, it represents only the thin sliver of inventory that is actually trading hands. During downturns, lower-priced listings tend to dominate, making the data appear softer than the brutal reality facing buyers. The primary driver keeping prices elevated is a phenomenon the U.S. has never experienced at this magnitude: rate lock-in. Between 2020 and 2021, millions of homeowners refinanced into sub-3% mortgages. These owners are now financially handcuffed to their properties. Selling would mean trading a historic low rate for one that is double or triple the cost. Consequently, even those needing to move for jobs or family reasons are holding their properties, often choosing to rent them out rather than sell. The absence of distress. This behavior drains massive liquidity from the market, creating an artificial floor under prices. The shortage is driven not just by a lack of construction, but by a refusal to release existing inventory. Furthermore, because these locked-in owners possess strong equity positions, they do not panic sell. This eliminates the primary mechanism that historically resets prices: forced selling. Without distressed inventory, the market cannot correct downward, it simply stalls at a high plateau. We see the consequences in cities where ownership has become a mathematical impossibility. New York, Miami, and San Jose now operate at price-to-income multiples of 10 to 12. Even by global standards, these markets are severely unaffordable. These are not temporary bubbles. They are the result of structural demand, job concentration, and restricted supply colliding. As these markets decouple from national averages, young buyers are exiled, forced to delay ownership into their late 30s or abandon the dream entirely. Desperate measures. This breakdown is fundamentally altering the structure of the American household. Adult children are retreating to their parents' homes. Couples are cohabitating earlier to split costs. Desperate buyers are turning to 40-year mortgage terms, 1% down payment programs, and other last-resort financing tools that spread the pain over decades. These mechanisms do not lower the cost of housing, they merely mask the agony of the monthly payment. If this is level 1, the crisis is not nearing its end. It is mutating into something deeper, slower, and harder to reverse. Beneath these surface symptoms lie structural pressures that are actively reshaping the landscape. Level 2, internal pressures. Consolidation and the uneven economy. If Level 1 demonstrates that affordability is broken, Level 2 explains why the market continues to tighten even as demand logically cools. This is no longer just a pricing issue. It is a structural shift in how America works, migrates, and builds. These pressures are reshaping where opportunity exists and who can afford to access it. The most potent force is economic consolidation. For decades, employment was distributed across hundreds of counties, allowing families to find affordable living without sacrificing their careers. That balance has eroded. As of 2024, a mere 31 counties generate more than one-third of the nation's entire economic output. A country of over 300 million people is becoming dangerously dependent on a handful of metro regions. When opportunity clusters, humanity follows. This drives housing demand in specific regions far faster than supply can react, creating a bifurcated America. Areas with booming industries, tech in the Bay Area, finance in New York, biotech in Boston, and corporate hubs in Austin or Nashville, absorb the majority of high-paying jobs, sending local prices into the stratosphere. Meanwhile, regions losing industry face stagnation. The chasm between economic magnet cities and the rest of the country widens annually. Migration and the zoning straitjacket. This polarization dictates migration. During the pandemic, Americans moved in record numbers, fleeing expensive metros for space and affordability. Cities like Tampa, Salt Lake City, and Phoenix absorbed double-digit population inflows, instantly spiking home prices beyond local wages. However, as mortgage rates surged, mobility paralyzed. Owners with low rates stayed put, and renters found fewer viable destinations. The nation has stopped moving, yet price pressure remains. Exacerbating this is the zoning crisis. For decades, municipalities have engineered barriers to construction. Lengthy permitting, local opposition, and labor shortages ensure that even when demand spikes, supply is capped. While some markets attempt to liberalize zoning, the progress is too inconsistent to offset the structural shortage. The investor and insurance squeeze. Institutional capital adds another layer of density to the problem. Large-scale entities, from private equity to real estate investment trusts, are aggressively acquiring single-family homes, specifically targeting the entry-level segment. Properties that once served as starter homes for young families are being converted into permanent rental stock. In some metros, investors control 10% to 20% of available inventory. When cash-rich funds outbid families, prices drift further out of reach. Simultaneously, insurance markets are amplifying the crisis. In Florida and California, major carriers are exiting due to climate risks and replacement costs. When premiums double, affordability collapses, yet prices oddly do not. Instead, the buyer pool shifts. Wealthier households who can absorb high premiums or pay cash replace those dependent on financing. The market narrows, supporting higher prices even as general affordability crumbles. Combined, these forces create a market that defies traditional economics. Demand falls, yet prices hold. Inventory stabilizes, yet accessibility vanishes. The mechanisms that once balanced the market, mobility and flexible supply, have failed. If these trends persist, the US could drift into a new equilibrium where high prices exist independent of economic cycles. Level 3, the ceiling America hasn't hit. The global warning. If Level 2 explains the internal pressures, Level 3 reveals a far more unsettling truth. The US has not reached its affordability ceiling. By global standards, and even by its own historical trajectory, America has room for prices to climb drastically relative to income. This is not because wages are soaring, but because the structural dynamics of the US market are beginning to mimic countries where affordability ratios are 2 to 3 times higher. Consider the benchmark. The US price-to-income ratio sits around 5. However, in nations with similar economic profiles like Canada, Australia, and the United Kingdom, ratios of 8 to 10 are considered the new normal. In their major metros, double-digit multiples are standard for even modest dwellings. While this analysis focuses on America, the comparison is vital. These nations prove that housing markets can remain stable and exorbitantly expensive for decades, operating at levels Americans currently deem impossible. The uncomfortable question is whether the US is drifting toward that same fate. The answer appears to be yes. The closing of escape valves. The pressures pushing those nations into extreme territory are now accelerating in America. Job concentration in tech, finance, and logistics mirrors the centralization seen in Sydney, Toronto, and London. As opportunity compresses into fewer cities, housing values disconnect from local incomes and begin tracking global demand. We already see this in New York and Los Angeles, where ratios have quietly crept into the 10 to 12 range. These cities are not outliers, they are harbingers. When housing reflects competitive bidding among high-income earners, investors, and global capital, local wage earners lose the ability to influence prices. This is how Boston, San Diego, and Denver have joined the ranks of the unaffordable. Historically, families priced out of major hubs could relocate to secondary markets like Charlotte, Nashville, or Phoenix. But as pandemic migration accelerated, those escape valve cities absorbed enormous demand, pushing their own prices up at record speeds. Many once affordable metros have transitioned into the unaffordable range, leaving young buyers with dwindling alternatives. The structural scarcity. Supply elasticity is the final broken mechanism. Economists assume that rising prices trigger a building boom. But US construction is throttled by land scarcity, regulation, and material costs. Even in optimal scenarios, construction is slow to respond. When demand spikes faster than supply, prices jump and rarely return to baseline. Could America reach price-to-income ratios of 8 or 10 nationwide? Not overnight. But the guardrails that kept prices in check during the 20th century, cheap land, distributed jobs, and high mobility, are gone. What remains is a market driven not by fundamental affordability, but by structural scarcity. This sets the stage for the final level, the social transformation of the American people. Level 4, the turning point. Restructuring the American household. By the time a housing market hits its structural limits, prices are no longer the story, behavior is. The United States is entering an era where households are restructuring themselves to survive a market they can no longer control. This shift signals that affordability pressures are reshaping the social foundations of how Americans live. The first warning sign is household size. For over 160 years, the average number of people in an American home trended downward, signifying independence and prosperity. Recently, that trend reversed. This is not due to a baby boom, but because adults are moving back into multi-generational homes. The share of 18 to 34-year-olds living with parents has reached historic highs. This is a survival tactic in a market where renting prevents saving, and buying requires a down payment exceeding a year's salary. Multi-generational living acts as a pressure valve, redistributing costs so younger generations can survive. While common globally, this represents a historic fracture in American individualistic norms. The forever mortgage and the shrinking home. Another sign of structural strain is the evolution of debt. 40-year terms and 1% down loans, once fringe products, are normalizing. These tools reduce monthly payments by dragging debt further into the future. The trade-off is massive, interest costs balloon, and equity builds at a glacial pace. Americans are effectively agreeing to pay more over a longer period just to secure a foothold. Simultaneously, housing preferences are contracting. For the first time in 50 years, the average size of a new U.S. home is shrinking. The demand for bonus rooms and expansive square footage is evaporating, replaced by a need for basic attainability. The American dream is being resized, not by choice, but by necessity. The two Americas. Finally, we see geographic fragmentation. The U.S. is splitting into two distinct housing realities. In one America, places like Austin, Raleigh, and Boston, growth maintains relentless price pressure. In the other, aging regions with stagnant employment, demand slows. The gap widens annually. Young professionals are forced to chase opportunity in metros where affordability is collapsing, while lower-cost regions fail to offer economic mobility. This divergence reinforces the ceiling. When people cluster into fewer hubs, supply tightens further. The U.S. housing market is ceasing to function as a flexible national system, becoming instead a patchwork of localized breaking points. Conclusion. These behavioral shifts, multi-generational living, extended debt, shrinking homes, and regional segregation, are not temporary shocks. They are the foundation of a new equilibrium. We are witnessing a market that does not rebound after a cycle, it resets to a permanently higher baseline. The 4 levels explored here point to a singular reality: the U.S. housing market is not drifting toward stability, it is redefining what normal looks like. Affordability isn't waiting for rates to fall. Instead, the market is forcing Americans to change how they live, move, and plan. Understanding these levels provides the only roadmap for navigating what comes next. If this breakdown clarified the chaos of the current market, make sure to subscribe so you are never blind to the next shift in America's housing future.